Right, welcome to lecture 1-B of FGM GT 1100. Before we kick off with the lecture, though, I want to emphasize something very important, and that is the concepts that are covered in this particular lecture are foundational. They're critical to your future continued understanding of accounting, and therefore I want to urge you to, before you go any further, read page 16 to 22 in the 9th edition Horngren textbook. And that will give you an overview of what we're going to talk about here, and then we're going to go through it again. And through that repetition, you should develop a better grasp and understanding of the concepts that we're going to discuss here. Okay, so pause the video now, go and read those few pages, and then come back. Now, I'm assuming at this point that you have done that reading, and so we're going to carry on with the lecture itself. But before we do that, we're going to do a quick review of some of the material we covered in the last lecture. And so there are 7 accounting standards that were discussed in the previous lecture, and let's try to list them and their names. So, first one, the economic entity assumption. And this one talks about the business being a separate economic entity from the personal affairs of the business owner. Number 2 was the reliability characteristic. And the reliability characteristic states that accounting records need to be based on the most accurate and verifiable data, and that typically in our in what we do means that they're based on the historical cost, what something was actually paid for. So the real live dollar value of the transaction is going to be the most reliable indicator of what something is worth. The third principle that we talked about, or standard that we talked about, was the cost principle. And this flows a bit from the reliability characteristic in that it states that assets and services should be recorded at their actual or historic cost, what was actually paid for them. The fourth standard is the going concern assumption. And I should add that the order of these is not critical, as long as you sort of get all 7 and have a rough idea of what they mean. That's what's important. So the going concern assumption assumes that the business entity is going to remain in business or in operation for the foreseeable future, and this has to do with the way that value is determined. So it's assuming that the business, the value of the business is based on the income that it generates into the foreseeable future. Number 5, the stable monetary unit. And this really has to do with inflation, and it basically, this particular assumption states that the monetary unit in question with which we're going to account is stable from an inflation standpoint. In other words, inflation is a very small or a minimal, has minimal effect on it, and therefore, for our purposes, it allows us to ignore the effects of inflation on financial records and so on. The 6th one is the cost-benefit constraint. And it basically states that if you expend resources or money to create or record or capture or produce information, the benefits of that information should exceed the cost that you incurred to do that capturing and recording and producing. So the benefits of the information need to outweigh the cost of creating that information or capturing that information. And the final one is the materiality constraint. And this simply states that the information that we do go and capture and record and report has to be large enough that it is going to influence anyone who's a decision maker or relying on the information that we're producing to make decisions. So it can't be so insignificantly small that it doesn't influence decision makers. And the little caveat from an educational standpoint is that because we need to make sure that you're doing stuff correctly and appropriately, while somewhere in the business world a $10 transaction people may not bother recording it. For our purposes, you're going to record everything down to the penny, if not more, simply because we want to make sure that you know exactly what it is that you're doing. Okay, so today's lecture is going to cover something called the accounting equation and also business transactions and how we go about accounting for them. This will allow us to begin to do some rudimentary accounting. So, the accounting equation itself. It is the accounting law of gravity, right? So if something is always true everywhere, you drop an object, it falls. Well, same sort of thing in accounting. The equation is assets always equal liabilities plus owner's equity. So again, assets equals liabilities plus owner's equity. Okay, and like I said, it always holds true. So how does this work? Well, every time we look at a transaction that takes place in a business, we record it using this assets equals liabilities plus owner's equity framework. And the recording of the business transactions is the foundation or the beginning of the accounting process itself. So before we carry on further than this, though, let's actually try and define what we're talking about. What is an asset, a liability, and an owner's equity? Now, many people will think, what's an asset? Oh, I don't know. You know what you think it is, and so on. But in accounting, we have very specific definitions that may not exactly line up with what you believe or understand an asset to be. So, what we call an asset is an economic resource that is owned by a business and that is expected to be of benefit in the future. So, a resource that is going to be used to generate revenue, right? It is expected to be a benefit in the future. Okay, and that can be, the future could be tomorrow, but it could also extend many years into the future. So some examples, land is an asset. Cash is an asset. A factory is an asset, right? It produces products that you turn around and sell. And something called accounts receivable, which is essentially IOUs from people who have sold, who have bought stuff from you and have promised to pay you in a couple of weeks. So the fact that somebody owes you money is an asset. Okay, so now, liabilities. Liabilities, by our definition, are creditors' claims to these assets. They're obligations to outsiders. So, in other words, in a way, it's kind of the opposite of an asset. It's someone who has a claim against the business. The amount that the business owes to them is a liability, right? So it's an amount owing. An example would be a loan, or similar to the accounts receivable we talked about previously, something called an account payable, where maybe you have bought something from somebody and you've agreed to pay them in 2 weeks or in 30 days. Well, the fact that you owe them money is a liability. Now, so when we talk here as well about creditors, a creditor is simply someone to whom the business owes money. Okay? And then the third part of the accounting equation is owner's equity. And what is that? It is the owner's claim to the assets of the business. So if we go back to the diagram we have here, the business has a bunch of assets. It owes some financial obligations, liabilities, and it's going to, in theory, use, or could, if required, use some of these assets to pay off all of the liabilities. Whatever's left over after that's done belongs to the owner. And so that's why we say that owner's equity is the owner's claim to the assets. It's and it's equal to the amount of assets that remains after all the liabilities are subtracted. So again, if you think back to our diagram up here, assets, visually you can see the representation. Assets are equal to the sum of liabilities and owner's equity. So if we look at the diagram below, it kind of explains a little bit some of the transactions that can affect increase or decrease owner's equity, which will hopefully make it a little bit more clear for you. So how does owner's equity go up? Well, if the owner themselves take a bunch of cash and invest it in the business, cash or other assets, right, that contribute that to the business. And conversely, if the owner pulls cash out of the business, then the owner's equity is going to decrease. But the other way, and the way that is perhaps more interesting to anyone in business, is that revenues and expenses will also increase and decrease owner's equity. And this has to do, revenues come from performing services. So if you're a consultant, you go and do some work for somebody, or it can come from selling goods. If you are a store and you sell products to someone, you generate revenues. And expenses are those costs that are incurred in order to generate these revenues. So these two items, and we'll get into a lot more detail on them eventually in the course, those two items are the primary source of increasing and decreasing amounts to owner's equity. Again, though, we don't want to disregard the fact that the owner can contribute or withdraw cash from the business, and that will, of course, also increase or decrease owner's equity. So, as I've just discussed here, owner's equity is increased by owner investment and also by revenues, and it is decreased by the owner withdrawing assets, typically cash from the business, and expenses that the business incurs. Now, if we rearrange the accounting equation slightly, we can rewrite it as assets minus liabilities equals owner's equity. And so this is a way that the owners of a business can get a sense of how much their interest in the business is actually worth. So why do we go about bothering, though, classifying information into these three groups? Well, if we understand the difference between information and just data, right? Data is kind of disorganized information that's just sort of lying around out there, but information itself is actually organized data. So, and it's organized in a way that provides useful information or utility to a user. So if we can organize the data by grouping our accounting records into assets, liabilities, and owner's equity, then we're providing more usefulness or utility to someone who is using that information. And so that's why we go about categorizing that in those forms. Now, let's look at business transactions. So a business transaction, and again, definitionally, this is kind of important, it's an event that affects the financial position of a business and, very important, it has to meet those two tests and can be reliably recorded. Right? So it has to have those two items in it. So let's take a look now at a list of transactions and how they might affect a business using the accounting equation. So if we take a look at this particular business by the name of Ladner Environmental Services, we're grouping the assets here on the left, liabilities, and owner's equity. And then we're explaining a little bit the kind of owner's equity transaction that we're going to be looking at. So again, the very first transaction up here, the business recorded the $250,000 cash investment made by Mr. Ladner. Okay, or Mrs. Ladner, I guess. So the owner contributes $250,000. So following the accounting equation, we discussed that cash was an asset, so it is appropriately shown here. So cash is going to, in the business now, is going to go up, because before this happened, the business had zero cash. The owners put some cash into it. Now the business has $250,000. But following our accounting equation, we have to also have, the accounting equation has to hold true. So if assets go up by $250,000, somewhere liabilities and owner's equity also has to go up. And we've said that owner's equity increases when an owner contributes assets. So we have owner's equity increasing by John Ladner contributing $250,000. Right? So there's the first transaction. And then after this transaction, we have this ending balance, right? $250,000 cash, $250,000 owner's equity. Okay, so we've done number one. Transaction number two. The business paid $10,000 cash for land. So cash goes down by $100,000. And the asset land goes up. So again, assets equals liabilities plus owner's equity. Does that accounting equation hold true? Well, yes, it does, because assets have gone down by $100,000 and gone up by $100,000. So the dollar value, total dollar value of assets haven't changed, although the distribution of assets within the business has. Number three, bought $5,000 of office supplies on account. Now, anytime you see the term on account, it means that we are buying them using account payable, or if we're selling, it's account receivable. In other words, they will be paid for at a later date, and that's just the way that business to business is often done. So when we buy something on account, what happens is that our assets, called office supplies, are increased, as you can see here, and because we haven't paid for it, cash hasn't gone down, we haven't paid for it yet, but we owe the money, and when we owe money to somebody else, it's a liability, and in this case, it's a liability called account payable, and so that liability goes up also by $5,000. So again, assets up equals liabilities up plus owner's equity, no change. So the accounting equation remains solid every time we do a transaction. And we will continue this lecture in Part B.